Nice. So every region has its nuances. How do you see primary versus secondary markets performing in the current environment? Like,
Um, yeah, no, I see what you're saying. So I think that it's kind of interesting because COVID did a lot of interesting things, and when COVID hit and there was the shutdowns, it was interesting because a lot of people moved out of primary markets into secondary markets because of remote work, right? So you had a ton of people move out of New York into Austin because of remote work. Probably better Los Angeles to Austin, and then maybe from New York to Palm Beach or something like that, or New York to, I don't know, like Tampa. Um, and and so when you're looking at primary markets and secondary markets, historically, it's been that the primary markets are a lot more liquid, meaning that, if you wanted to sell, or if you want to sell, oftentimes you're doing an exit analysis, especially if you're not holding too long of a term. How easy is it for me to sell it? Well, it's going to be super easy to sell a property in Miami because there's a huge demand because it's a primary market, let's say, compared to I don't know, Pensacola, which is a tertiary market. And that being said, because there's so much demand, it really pushes down your cap rate, which pushes down the yield. So once you own it, if you bought it for a lower yield, now you're going to be making less money per year unless you increase the net operating income for that property. So you have to do a little bit of lift that way. But that being said, you probably have more demand for the vacancies themselves in a primary market, because a lot of the retailers that are expanding, they look at primary markets first. And so you do have a higher demand for leasing, and maybe you could push rents. That being said, there's only so much rent that that a tenant can pay. So the advantage of being in a secondary or tertiary market is that you're buying it for below replacement cost. You bought it for a good basis, and you can afford to do a cheaper rent. And maybe that becomes more sustainable, during down cycles. If you're paying a $80 a foot rent versus a $20 a foot rent, perhaps there's a higher likelihood of that higher rent paying tenant, going out of business. You kind of saw that a little bit on Lincoln Road, where the rents got to like $200-300 a square foot, and it kind of there was a down cycle, and things cleared out a little bit. So I just focus on probably liquidity, the demand for the spaces themselves, and you're probably getting a little bit better debt on the primary markets as well.
makes sense. Do you think suburban shopping centers are becoming more attractive than urban retail spaces?
Well, I think it's cyclical, right? So urban was very, very much very popular from was it mid 2000s. There was a flight from suburb to walkable, and things like that. And then during COVID, there was a kind of a move to suburbs and even exurbs. I think that's like further out than suburbs. I think a great place to be in would be first ring retail. So, you want to be close enough to the downtowns that it's not too inconvenient to get down there if you need to do business, or, go to a show or something like that. And maybe you don't want to be you want to be far enough away so that you kind of get out of the pandemonium a little bit. That's from a, living standpoint. As far as investing, it's two totally different asset classes. When you, or it's the same asset class, but two different sectors within the asset class. So when you're looking at urban, you don't have common area often. You're not dealing with a lot of landscaping and parking lots and things like that. You're not dealing with probably as much co-tenancy and use restrictions, because if you're on Lincoln Road, a lot of times the ownership's fractured, meaning that the store, you have 10 stores adjacent to each other, but that might be 6 different owners. When you're dealing with suburban, it's very different in that you got a lot more land that you're dealing with, which is good because you own a lot more land, but then you have to really maintain it. And there's operational factors that go into that.
Yeah. You've been in commercial real estate since the 2000s, and you've worked with some major industry names before joining Saglo. Looking back, what's the biggest lesson you've learned about long-term success in retail real estate?
Well, I think that having a good track record is so important. I think that being well capitalized, meaning and having a good track record, not taking on too much leverage, and having the relationships to get the deal done. I think in all of the places that I worked at prior to Saglo, and they're all successful and continue to be successful. They've all leveraged those attributes to really propel their business forward, and also to get the best talent, because it's a people-driven business, and I think that people like working at places that offer them stability, that offer them security, and also have been around long enough, and to have the processes kind of nailed down. And then for you to be able, they also want to be places that are growing, and for you to be able to grow, you need to have those relationships, and you need to have that capital as well.
That was amazing advice.
The desert heat, bright lights calling from the Vegas streets. Name tag on and a game face tight. Here to deal, here to shine, here to get it right. ICSC's where the big leagues meet. Deals get done, no time for sleep. Retail pulse in every stride. I'm repping Saglo, let's ride.